Ladies and gentlemen, boys and girls, welcome back to the channel. This week, I'm going to share something with you that I actually saw on Tuesday on CNBC. It was an interview with Hsieh, the CEO of LoanDepot, and it's only a 4-minute short interview, but I want to break down what he said and how he said it, because to me, it was super impactful and super telling of where the market's going and some of the things you should expect to see in the coming months. So strap in. This one's going to be a little fun. Okay, so a little bit of backstory before we jump into this. Hsieh, the CEO of LoanDepot, has a long storied history in the mortgage industry. And I don't want anybody to have any false, thoughts about this whole thing. I respect the man immensely. He was named a billionaire earlier this year. If anybody knows the mortgage industry space, it is him. All I'm saying with this video is a breakdown. There were some interesting things that were said and the reasons why they could be said, and definitely some of the financial impacts. A lot of this channel is about financial literacy and understanding things from a bigger, broader perspective. And interviews like this are always seen on news outlets and news channels. And I wanted to deconstruct this one because I think there's a tremendous amount of value for you, the consumer, if you can read between the lines. Because no CEO like Hsieh is going to come out and say terrible things for his company. Remember, Wall Street's watching, his employees are watching, his consumers are watching, and you've got to keep confidence levels high. The last thing you want to do is do damage to your own company because you're portraying an image that isn't confident in your ability to weather a financial storm. And that's what we're in right now, a looming financial storm. So the backstory with Hsieh is he started what was a mortgage company and then ultimately sold it to E-Trade Bank. He then went and retired. He's a big, I think it's a fish, sports fisherman, like big fish. Open sea stuff. It's a very expensive sport, something that you and I probably couldn't afford. But he basically retired and went off and did that for a while. He came back and started Home Loan Center, which was the lending arm of LendingTree. Doug Lebda ran LendingTree. Hsieh ran Home Loan Center. It was ultimately sold to Interactive Corp, Barry Diller's company. He stayed on for a little while. Interesting side note is the CFO of Interactive Corp, who bought LendingTree and Home Loan Center, was Dara, who is now the CEO over at Uber. So these people are professionals. They're seasoned. They've been in business a long time. After Anthony sold that company, he went off and retired again and got into the fish game again. I don't know the proper vernacular around it, but suffice it to say that he came back and he started LoanDepot 12 years ago. And for 12 years, it had an exceptional growth rate. By all outward measures, it was astonishing and unfathomable. Enunciation is not my skill set. Nonetheless, the growth was special. But you could also say, from an outside perspective, that the growth happened because the real estate economy was so unique. Artificial interest rate deflation, real estate growth like we've never seen before, supply issues, unchecked demand created what we now know is to be a supply shortage of homes in the market, and this wildfire time in the real estate industry. And normally, recessionary economies, like you've heard on this channel, go from 7 to 10 years from peak to peak or trough to trough, and we're now in 14 years. So setting all that up, Anthony took the company public earlier this year, and he's going on CNBC now to talk about something bad that happened. His Q4 numbers came out, and what happened? 90.5% drop in earnings. That is a massive fall off, and there is reason to be concerned when any public company, especially one that's been public for a year, falls that much. At the time of this, that Tuesday, he was down 7% on the day and 80% down from the IPO price. Down to, I believe, around $3.77 was where it closed. In aftermarket trading, it crept up to about $3.79. The 52-week low was $3.55. So you can see that they're really hitting that 52-week low. And if you look at the expanded map since the IPO down to now, obviously it looks pretty much like a straight line down. That is bad. If Wall Street's concerned, everybody else is concerned. What do you do as a CEO? You man up, you get in front of a camera, and you talk about it. Now, the next day after this conversation, spoiler alert, the stock price went down another 9% to almost 90% off the IPO price to the prices I just gave you at the $377. So the fall off did not stop after this interview. Let's jump into the discussion and let's break down what Anthony's saying.
Let's start with the earnings report this morning. You noted that the mortgage market is under a period of, quote, pressure right now. We know that because of mortgage rates going up, and the Mortgage Bankers Association is forecasting a 35% drop in mortgage originations. How does LoanDepot stomach that?
Well, hi, Diana. First of all, we have to keep in mind that we're in an industry that often adjusts very rapidly. So in any other industry, when your demand changes by 35% year over year, you have to be able to be very agile and pivot. And that's exactly what the winners in the space is going to do. We also need to understand post-financial crisis, or Dodd-Frank, if you will, the barrier to entry on this new higher level of regulatory oversight is going to be extreme. So the total addressable market, although we're getting into a negative trend with lower volumes, the total addressable market is going to continue to grow because of population growth and average loan amount going up. So the market's just going to get bigger. And those that are in the position today is going to continue to scale. And this is just a great opportunity to continue to grow market share.
So in that clip, Anthony talks about the growth of market share that his company will be able to get as the growing single-family residential economy continues to grow and more people become home buyers. That has been a simple statement that's happened every single recessionary economy. And I'm not necessarily sure that's accurate or not accurate. I guess the argument here is that there will always be people who are willing to buy homes, except companies like LoanDepot are 70 to 80%. I don't know the number exactly, but it's usually somewhere around there, heavy in refinances. So as interest rates continue to rise, the refinance market will effectively drop off. And if you're 70 to 80% in refinances, you could lose a lot of business. And people could say, well, hey, Chris, interest rates haven't gone up yet. That's supposed to be in March where the Fed's going to signal to do that. And that's when the next meeting is. So why is all this happening now? It's because the market, if you look at the Bloomberg's probability index, has already priced in at least a 25 basis point increase in rates. And the long end of the yield curve is already showing that pricing now baked in. And most lenders are pricing up accordingly. So what does that mean? That means the secondary market, people who would normally invest in LoanDepot, are concerned about LoanDepot's ability to continue to generate revenue, knowing that interest rates are going up and their refinance volume is going to take a hit. Anthony himself, in this same statement, also talks about the Dodd-Frank Reform Act. Well, I would argue that that came about as a result of the Great Recession in 2009, and that added a lot of complexity to the compliance burden on lenders, a lot of disclosures to the consumers, and a lot of rules and timelines. Those are well heeled at this point. People know those rules, and I'm not sure that any lender is going to fall off the map because of the extra burden in reporting requirements compliance. For 14 years, people have been doing it. Let's just say they've been doing it for 7 or 8 years to be conservative now after being put in law, out in practice, and now use. People know those laws. So I'm not sure that's really prohibitive to the industry growth in market consolidation. The other thing that he makes reference to here is you have a $4 trillion single family market, which we now all appreciate, including Anthony, is going to shrink down to a $3 trillion market. So what Anthony's trying to say is that he has things which he'll go on to talk about in this interview that he's going to use as levers to try to grab more market share as smaller players exit the space and can no longer compete because they can't handle the compliance burden and they can't handle the growth, allowing more of their business to come in as, quote, market share for his company. I would say his next statements are even more telling about where his mindset's at.
And I was going to get on that. You talked so much this morning on the investor call about growing market share, which you did pretty dramatically from 2020 to 2021. But if you have that kind of optimism, if you think you can do that, where's the disconnect between investors? Because your stock is not just having a rough day, but a rough year.
Well, we understand the fact that, this is very early in the cycle. Post-financial crisis, again, this is an all-new community trying to understand how to evaluate different mortgage companies, different mortgage stocks.
So look at those words there. This is very early in the cycle. Anthony is signaling with his 30 years of experience, and again, I will say it one more time, I respect the man's experience immensely. I don't think he's mismanaging anything. I think he's accepted what the rest of the society hasn't generally accepted. We are already in a recessionary economy. Hence, he's saying we're adjusting to this period in the cycle, meaning we are starting the next phase. We are starting that downward phase of that sine wave we talk about so much on this channel. We are going into, and we will look back and say, this is already a recessionary economy. Now, I'm not saying that home value is going to crash, you should freak out, inflation is going to go above 7%. What I'm saying is this is a longer, prolongated process. The elasticity has been removed from the economy and nobody knows what happens next, which is also why Anthony has said in that statement that nobody really knows how to value mortgage companies anymore. Well, mortgage companies have been around for a long time. Clearly, Anthony's been in the space for 30 years. We are in that unprecedented economic time that we talked about. So nobody really knows what happens next after all the things that I told you about previously, right? I mean, when have we had stimulus like this? When have we had a PPP program? When have we had COVID before? So nobody really knows how non-bank lenders and mortgage companies are going to respond to this type of economic pressure. I would say there's a little asterisk here. Banks have other income sources, most notably the net interest income that they make on the difference between loans and deposits, whereas non-bank lenders have a source of capital, which is usually more expensive than banks. So this is really a non-bank lender problem and your mortgage banking problem, not necessarily a banking traditional bank environment problem. So let's jump into it. These statements are already setting you up for what I think is an understanding that the market is going to change. But Anthony addresses that, again, very, very impressive in how he handles this head on.
So in addition to our $11 trillion of overall industry volume, last year, because of low interest rates, the industry broke an all-time record, Diana, over $4 trillion of business. We're adjusting to a forecast of $3 trillion this year. So there's excess capacity in the industry that needs to shrink down or adjust down. And while that's happening, there's a lot of pressure to margins because people are becoming very aggressive in their pricing structure, but that is not sustainable. Your strategy is, and the barrier to entry is going to limit new players from coming in. So this is just an adjustment, and this is not anything new, unfortunately, but it is part of the natural process, and the market just will get larger as we come out to the other side.
So what Anthony said there is really, really important for you to understand. He has now said openly in front of his company, in front of investors, in front of shareholders, in front of everyone, that he knows that the general consensus is the market is going to consolidate from a $4 trillion historical high to a $3 trillion market. Effectively, when he's averaging out numbers that are approximating numbers, I should say, that are about a 35% anticipated decrease in the single family market. If 35% of the business goes away, it's very, very difficult for everybody to make the exact same amount of money that was there. And what he's suggesting is that there are going to be players in the business that are going to go away. Right now, they're trying to price super, super low to continue to bring that business in. A trend we have seen in a lot of recessionary economies, including the Great Recession that we just came out of. What's unique about this economy, however, is that frankly, all recessionary economies going back to 1929 were immediately or relatively closely followed with a devaluation of real estate. In this particular economy, it's been so prolonged with this artificial deflation of interest rates and this artificial kind of holding things down and propping the economy up with those factors we already talked about, that the real estate change hasn't happened yet. Plus, we have institutional buyers in the single family market. We have super historic low interest rates where even a small quarter of a point interest rate increase isn't going to change the landscape. It's still going to be really, really cheap. There's a lot going on out there, and we obviously know the supply chain issues are difficult. There are very few homes in the market right now relative to what there used to be, and there's extreme competition in the markets, creating a very, very weird time. But Anthony is very clear this is not new. So what does that mean to you, the consumer, to you, people who have an interest in this? It means that the market has to consolidate. And if it has to consolidate, how does a mortgage company continue to move forward and maintain profitability in light of the lack of earnings? 90.5% down, 90% drop in their stock price since their IPO price. You have to let staff go. Layoffs have to be a point of discussion for efficiency, because if you're doing less business, you need to find ways to bring money back into the company that you're otherwise putting out. And that is the easiest way. Human capital in the mortgage industry is just the way that's done. That's not a malicious statement. It's not mean. That is just the way the mortgage industry has worked over the last 30 years of Anthony's career. And he's about to get asked a very pointed question about that. Keep in mind, his employees are watching this right now. The stock market, the shareholders, everybody's watching this. The way he answered this question was masterful.
Well, speaking of those margins, obviously you need to protect your expenses. Do you foresee, I have to say we did stories too, even 1 year ago, about so much hiring going on in the mortgage business. There were these job fairs. Do you expect to have to go the other way? That is, job cuts.
The entire industry are going to have to adjust down. When your demand reduces by 35%, something's got to give. And those companies with differentiated assets, such as LoanDepot, we have the second most notable brand in the industry. We have scale. We currently have over 10,000 employees funding 30,000 mortgages a month. And we have our own proprietary tech stack, Mello, that we've been building for the last 8 years. So along with the efficiencies that we're gaining and the scale that we have and the conversion and at the level of customer delight that we've been so heavily focused on, what we hope to accomplish through the cycle and what we believe is we can continue to penetrate market share. We increase our market share from 2.4% to 3.5% in a single year. The company's only 12 years old, and we've grown by over 45% annually, year over year, for our first 12 years. So we've done a very good job passing Wells Fargo on our 10th year, an iconic brand for us to actually help more customers and mortgages than someone like that tells you that we are doing something right. But this is a no doubt a negative trend in our industry, but it is not sustainable, and it will come back around.
So he did not directly say that he was going to make layoffs happen. What he said is the entire industry is going to have to adjust down. I don't know that I would have been able to handle that question as directly and as openly as he did. Frankly, I don't know if they discussed it beforehand, but the way he responded to that was not only ethically accurate, industry financially accurate, but it also indirectly belays the direct statement of saying, I'm going to lay off people tomorrow. Now, the unfortunate side effect of the things that he's talking about, I don't know that being the second largest non-bank lender by brand recognition in the last, call it 12 years, is as impressive as he wants it to be. I mean, beating out Wells Fargo, if you've been in the financial sector or you monitored and watched banks, you all know that Wells Fargo's had some brand reputation issues, which probably brought them down a little bit. But I will say that their growth has been somewhat astonishing. However, despite the fact they have this 12-year track record that he's talking about, remember the last 14 years have been this wildfire economy, unlike any other economy we've ever really experienced. Then you have this year, it's first and only year going public, and at the end of it, he reports a fourth quarter with a 90.5% drop in earnings, and now is down 90% again from that IPO price, the third time I mentioned it, because that is that important. These are significant problems. Problems the market's going to expect to be remediated. And he's already alluded to it. They have this technology stack. This 8 years they've been working on this proprietary technology. Well, how does proprietary technology save you money? You get efficiency from it. And what efficiencies do you get from it? Less humans involved in the process, and more technology allows you to pay less paychecks and have systems automate things. That's really what he's saying without saying that. Because if you have less FTE, full-time employees, human capital, you can save money. That combined with the fact that he's pretty much outwardly said the entire industry is going to have to lay off, and I'm well aware of other lenders that have laid off in that time, that you can expect that there's going to be some dramatic changes to the business, to the way he's doing things, and frankly, the arc of the entire lending industry right now. If your friends are brokers or in the real estate space, you may want to share this video with them, because this is a time to be proactive versus reactive. Know where the industry is going. There are those people out there who will say that there are, 8 offers on average going out before people buy a home. This has been a very, very heavy delayed purchase market. And maybe that makes non-bank lenders like LoanDepot very heavy in purchases for a prolongated period of time, where instead of being 25% of their business, maybe it's 30 or 40. But it's very, very hard to grow a business in the purchase space because it's so unreliable compared to a refinance business where you get somebody in, you get it closed, and you move on pretty quickly. Again, Anthony Hsieh is masterful at this. He should really teach a master class on how to articulate these things and how to do it with an open ear sensitivity to all the people that are watching him. There's a tremendous amount of pressure that we probably can never appreciate. The man is a billionaire. He is going to be successful for a long time to come. But this goes to show you that just the thought of the interest rate increase that's coming in March, and I'm going to go ahead and say that is almost a fact at this point, but it's perceived to be coming, and Bloomberg's probability index is super high on it happening, has already been baked into the business. The business around us today is already feeling those impacts. And if and when that does happen in March, you're going to see another set of impacts that come, because as the Fed signals what it's going to do in the next quarter, those assumptions will then be baked into the upcoming months leading up to that quarter, because nobody wants to be making loans below market when interest rates change, because non-bank lenders have to sell into the secondary market. If they're selling them loans into the secondary market that are less than the current market price of loans because rates have gone up, they actually take a loss on those. And because of that, now you're not making as much money on new loans. Now you're taking losses on the stuff you're selling on the secondary market. It's a very slippery slope. So be proactive. Think about the market as you see interviews like this pop up. These are wonderful buying times. Recessionary economies make millionaires. But statements like this, they're these short 4-minute videos, mean something. But you have to understand the audience, and you have to understand who and what and why they're saying it. Break these down. Deconstruct them. And maybe you can take some information that you can use to invest from these videos. Thank you so much for tuning in. We'll catch you next time.